economy. I'm joined now by Westpac senior economist James Shugg. I should say he's actually got an excellent track record at predicting these non-farm payrolls in Bloomberg surveys. I think the last time yours was the closest prediction that we had, and also the highest. Yeah. So not to put you on the spot too much, but what do you think is going to happen?
Well, we're actually a little bit more pessimistic about this figure today. We think there'll probably only be a 50,000 increase in private sector payrolls, and we think that the state and local government part of the hiring story is going to be very negative, shaving another 30,000 off the total, such that we only get a 20,000 increase in payrolls overall. If you look at the figures last month, they revealed in the revisions substantial weakness in state and local government hiring, and that of course is a reflection of the fact that that part of the government sector, with the exception of Vermont, can't run budget deficits, and so they're simply having to cut services, and with it they're cutting hiring as well. So that's going to be an ongoing drag on the labour market going forward. What
effect does QE2 have on that?
I struggle to see, actually, any sort of imminent impact from QE2. Yes, the banks are going to be injected with cash as they sell their Treasury securities to the Fed. But the issue is, do those banks then use those funds to lend, particularly to the small business sector, which is where most of the jobs growth will ultimately take place when the economy really starts moving again. And I see no real reason why banks are going to be more comfortable lending to the small business sector.
That's also where a lot of the bad loans have been.
That's right, and so there are sound reasons for the banks not to be lending to that part of the economy.
Yeah.
I mean, that's the whole nexus of the problem in the US. There is going to be a fundamental period of weakness, I think, going forward several years as the US economy works out these problems. And throwing all sorts of policy measures at it may not necessarily really have any substantial impact.
And in the meantime, we've got this issue now where the US is going down one route of QE 2 and 3 and 4, and they're almost saying we're going to keep doing this until it works. And yet over here in both the ECB and the Bank of England are really not going down that route at all.
Not yet. The Bank of England's not going down that route yet. We think they probably will next year. The inflation story is a little bit different in the UK. It's substantially higher than in the US. But certainly within the policy committee, there are individuals, there's at least one individual, we think, that wants to go down that path, and others might be swayed once it's clear just how much impact fiscal tightening will have on the economic growth story next year. For the time being, the UK numbers look kind of okay.
And you think that actually they will end up with some kind of QE light of some type next year?
Yeah, we're looking for another 50 billion sterling worth of asset purchases from the Bank of England, probably to be announced at the February meeting. They may only announce 25 billion at that stage, but we think there'll ultimately be a further 50 billion. And that's dependent upon the view that the UK economy does actually lose some of the very strong momentum we're seeing at the moment once fiscal tightening really starts to bite. For the ECB, it's possible that they could go down a quantitative easing path, i.e. buying assets off the banks and not sterilising those purchases. But again, given the current growth story, it's unlikely to come through anytime soon. We'd need to see the sovereign debt crisis really blow up again, and for that to have a significant negative impact on the economic growth story within Euroland for the ECB to go down that path.
Now, of course, in Europe and in the UK, the deficit is a major issue. In the States, it obviously doesn't have the same focus, but on the other hand, it is growing every day.
The budget deficit you mean to talk about? Yeah, absolutely. I think it is a significant focus. I mean, from time to time, people start talking about, will the US lose its AAA rating? I don't think that's going to happen anytime soon, but it is a focus, and it's going to be a particular focus if businesses and households take the view that any further fiscal stimulus is going to simply mean that there'll need to be higher taxes at some point further down the track to pay for it, given that the budget deficit is already so high. If households and businesses take that view, it might be that fiscal stimulus could actually be counterproductive in that it causes people to want to save more in anticipation of further tax hikes down the track.
Because really what they need to do is get Americans spending. It would also obviously help if exports improved, and that is something that the lower dollar, although they're not saying that this was the point of it all, will help with.
Look, the US is largely a closed economy. Yes, of course, there is a traded goods sector, but that's not going to be the driver of a substantial recovery in the US economy. It needs to be more domestically generated. You're right. The US economy needs to see spending, resume again, particularly household spending, for it to, get back to the sort of growth rates that they were comfortable with earlier this decade. I mean, it's not necessarily a bad thing. I mean, I don't want to put too many value judgments around this, but maybe it's time for the US to go through a period of regression, of pulling in a bit, and maybe when we come through this period, the economy will be in a better position to actually withstand any future shocks that come through, because the imbalances really were getting a little bit stretched over the last few years.
So a little bright note to end on there on a Friday.
Thanks.
Thank you very much indeed.
Cheers.